Part 1. The psychological root of why you love top picking and bottom picking. If you've ever asked yourself why you always feel a very strong urge to enter just a little earlier, to enter right when price has just climbed to the highest point, or just fallen to the deepest point, then stay with me. Because what keeps making you pick tops and pick bottoms is not in your system, not in your knowledge, and not in the market. It lives in a much deeper part of human psychology. A part that, if you refuse to look at directly, you can trade your entire life and still repeat the same mistake just on a different chart. There's a truth very few people dare to say out loud. A lot of traders don't actually want to make money. They want to be the smartest person in the room. Subconsciously, they don't want to follow. They want to be the one who saw it before everyone else realized. They want to be the one who entered at the exact moment the market reverses, so later they can say, "I shorted right at that top. I bought the exact bottom," not to prove how much the account grew, but to prove that I understand the market better than other people. This is the first root, the need to be right, more important than the need to make money. You can look back at yourself. A lot of top picking and bottom picking trades don't come from a clear plan. They come from a very familiar feeling. If I don't enter now, I will miss an important moment. What moment? The moment the market proves that you were right. Inside the mind of a top-bottom picker, there's a very seductive image. The image of someone standing outside the crowd, seeing what the crowd cannot see. A kind of subtle intelligence, a kind of victory by intellect, not by patience. The problem is, the market doesn't care how smart you are. The market doesn't pay money to the person who guesses the top correctly. The market pays money to the person who manages risk well and survives long enough. But the ego can't wait. Ego doesn't like waiting for confirmation. Ego wants to win right now. When you pick a top or pick a bottom, you are not trading the market. You are trading the image of yourself inside your own head. If I catch it right, it means I'm above the market. If I catch it right, it means I'm not an average trader. If I catch it right, I'm different from the crowd. This is the most dangerous trap because it disguises emotion as strategy. A trader doesn't say, "I entered because I want to prove I'm good." A trader says, "I see price is too high already. I see it's not logical. I see the market is about to reverse." But behind those sentences is a very pure emotion, the emotion of wanting to be right. You can learn as many indicators as you want. You can read as many books as you want. If this route hasn't been seen clearly, you will always find a way to enter earlier than the plan. And when the trade is wrong, you don't just lose money, you lose your ego too. That's why top-bottom pickers often find it very hard to cut losses. Not because the stop loss is far or near, but because cutting losses means admitting, "I wasn't as smart as I thought." It hurts twice. Lose money once. Lose identity one more time. And so, they hold the trade. They average down. They make excuses. They tell themselves, maybe the market just swept the stop and will turn back. Not because of analysis, but because the ego cannot handle being wrong. You need to remember one very important sentence, and if you can, put it right in front of your trading screen. Top picking and bottom picking is not a strategy. It is emotion disguised as intelligence. If you notice, you often want to enter at the prettiest points, the most dangerous points, the highest tops, the deepest bottoms, then don't rush to ask, which indicator am I using incorrectly? Ask this first. Am I trading to make money or to prove that I'm good? Part 2, Reverse FOMO. The fear of missing, the moment the market turns. There is a very big misunderstanding that most traders fall into. They think that FOMO only appears when price runs hard, when the market pumps or dumps, and traders panic chase the trend because they're afraid of missing the train. But the truth is, the most dangerous form of FOMO in trading is not chasing the trend. It is reverse FOMO. A trader is not afraid of missing the trend. A trader is afraid of missing the moment the market turns. You can recognize it easily because this familiar voice always appears in the mind. It's gone up too far already. It has dropped this deep, it has to bounce. It can't go up forever. It can't go down forever. It sounds logical. It sounds like the thinking of a calm person. But in reality, it is a very subtle fear. Not fear of losing money, but fear of losing the chance to be the person who entered at the historic moment. A reverse FOMO trader doesn't dream of catching the whole trend. They dream of entering at the exact point that later everyone looks back and says, "The reversal started here." They're not afraid the market will keep going. They're afraid the market will reverse without them being there. And so, they enter earlier than the plan, earlier than the signal, earlier than confirmation. They don't wait for the market to say, I have changed direction. They want to predict it. Because if they predict correctly, the feeling is very special. It doesn't feel like normal profit. It feels like an intellectual victory. I saw it before. I didn't need to wait. I wasn't like the crowd. But you need to understand one thing clearly. This is not patience. This is FOMO wearing the costume of going against the market. Traders often convince themselves, I'm not FOMO like other people. I wait for the reversal. But waiting for a reversal does not mean entering before there is any sign of reversal. When you short just because price has risen a lot, when you long just because price has dropped a lot, you are not trading based on probability. You are trading based on discomfort. Discomfort from watching the market go too far while you stand outside. Discomfort from seeing profits that should have been mine. Discomfort from seeing other people flexing trades that caught the exact top, the exact bottom. And the human brain cannot tolerate that feeling for very long. It needs action to release the tension. So the trader enters, not because the setup is complete, but because they need to shut down the stress inside their head. The irony is, reverse FOMO often disguises itself in very mature-sounding sentences. I'm not rushing, I'm just entering a small portion. I'm entering early to get a better position. If I'm wrong, I'll cut. But you and I both know. Once you enter from emotion, discipline rarely stays intact. One very dangerous feature of reverse FOMO is that it makes traders misjudge risk. They see huge potential profit if they catch the top bottom correctly. But they underestimate the probability of being wrong because in their head, they have already seen the reversal scenario. And when the market doesn't turn, when price keeps pushing farther, the pain doesn't only come from losing. It comes from the tormenting questions inside. Why hasn't it reversed yet? Why am I wrong? Or am I just a little early? This sentence, just a little early, is what kills a lot of accounts because it opens the door to holding trades too long, to moving the stop loss, to averaging down, to turning a wrong idea into a disaster. Reverse FOMO doesn't make traders lose because they lack knowledge. It makes traders lose because they cannot accept staying out. They cannot accept that. Missing a reversal is far cheaper than trying to predict it. If there is one sentence you must remember deeply, it is this. Not entering a trade is also a decision, and many times it is the best decision. Lassie Part 3. The illusion of control. This time is different. There is a very dangerous illusion that most traders fall into, more or less. It is not loud, it is not impulsive, and it doesn't make you feel like you're doing something stupid. On the contrary, it makes you feel like you understand the market very clearly. That illusion is called the illusion of control. A trader believes they don't just see price, but can read the market's mind, not through a specific signal, not through clear probability, but through a familiar feeling in the head. I see it now. I understand this rhythm. This time is different. From the moment you believe this time is different, discipline begins to crack. You no longer view the market as a random system with probabilities. You start viewing it like a being that is talking to you. Each candle is no longer data. It becomes a message. A pin bar? See, buyers stepped in. A fast spike? That's a stop hunt. Clearly it's about to reverse. A sideways move? The market is accumulating to reverse. You are no longer reading the chart. You are assigning personal meaning to the chart. And this is extremely dangerous, because when you believe you understand the market, you start loosening the very things that must be the hardest. Stop loss becomes more flexible. The plan becomes case by case. Discipline becomes negotiable. You tell yourself, I'm not breaking discipline, I'm adapting. But adapting is completely different from self-justifying. The illusion of control makes traders believe they can predict better than normal. That experience has given them intuition, that they are no longer beginners, so they don't need to be rigid anymore. The truth is the opposite. The more experience you have without iron discipline, the stronger the illusion of control becomes. Because you have enough memories to cherry pick. You remember clearly the times you caught the top, caught the bottom, but you forget quickly the times you caught it wrong and had to take a small loss or a big loss. The human brain does not store data fairly. It stores the moments that feed the ego. And so the trader begins to believe this story. I caught it right before, so I can do it again. But the market does not operate according to your memories. It doesn't know who you are. It doesn't owe you a single correct call. A very clear sign of the illusion of control is when a trader enters before the signal and then waits for the signal to appear afterward. The order is reversed. Instead of signal, entry, it becomes feeling, entry, search for a signal to confirm. And once you're in the trade, everything on the chart suddenly looks much more reasonable. Price goes against you, just noise. It hasn't turned yet. It needs more time. It goes even farther. It can't be sustainable. This is no longer trading. This is personal belief fighting probability. The illusion of control makes traders forget a simple but very hard truth. You cannot control the market. You can only control your risk. Every attempt to control outcomes leads to the same familiar ending. The stop loss gets moved. Risk gets amplified. A wrong idea becomes a massive position. And when the account collapses, the trader doesn't say, "I was wrong because of the illusion of control." They say, "This market is irrational this time." But the market never promised it would be rational in the way you want. Part 4. The Market Hero Syndrome. There is a very powerful image living inside many traders, an image that doesn't come from books, doesn't come from trading courses. It comes from stories repeated again and again in the community. The image of someone appearing at the perfect moment, right when the market collapses, right when the bubble bursts, right when the crowd panics. That person doesn't chase, doesn't hesitate, doesn't fear. That person shorts the top or buys the bottom. And later, the story is retold like a legend. I entered when everyone was still clueless. I saw it before everyone doubted. I'm not like the crowd. This is the market hero syndrome. A trader no longer trades for profit. They trade for the story they will tell, the story that makes others impressed, the story that makes them feel special. The problem is, the market doesn't pay for stories. The market pays for probability, for correct repetition, for boring and consistent discipline. But that doesn't create legends, doesn't create moments, doesn't create wow. And the trader's ego loves wow. Top picking and bottom picking is the perfect stage for the hero syndrome, because with just one correct trade, all the wrong trades before suddenly become worth it in memory. The trader doesn't talk about the 10 small stops that got swept before. They talk about the one trade that caught the entire crash. The brain loves that kind of story. It's short, it's dramatic. It makes you feel like you're not an average trader, but trading for the story is the shortest road to disaster. Because when you trade to be the hero, you cannot accept a normal outcome. A break-even trade, too ordinary. A small trend-following win, not satisfying enough. You need a big hit, a reversal moment, a going against history moment. So you enter at the most dangerous zones, where risk is biggest, where mistakes are punished the hardest. The hero syndrome makes traders gamble their identity on every trade. If it's right, you don't just gain money, you gain pride. If it's wrong, you don't just lose money, you lose your self-image. That's why this type of trader finds it very hard to cut losses, because cutting losses means admitting, I'm not the one who saw it first. So they hold, they hope, they pray, not for money, but for the story to continue. There is something deeply ironic here. The most consistently profitable traders have no story to tell. They don't remember where they entered. They don't remember which top they caught. They only remember that they followed the process. No one makes movies about them, no one writes praise pieces about them, but their accounts survive year after year. Meanwhile, many market heroes disappear from the market early, not because they are stupid, but because they put ego before probability. If you notice, you love the moment the market collapses. Love the feeling of, I told you so. Love imagining entering at the top and then retelling it. Stop for a moment and ask yourself, am I trading to build an account or to build a story? Part 5. Confusing high-low with expensive shape. There is a very basic mistake, but extremely common in a trader's thinking. It sounds harmless, but when combined with ego and reverse FOMO, it becomes a deadly trap. It is the confusion between high-low and expensive cheap. A lot of traders look at a chart and think like this. Price is already this high. Buying here is expensive. Price has dropped this deep. Selling here is cheap. It sounds reasonable. It sounds like everyday logic. But the market doesn't operate on everyday logic. In trading, high or low means nothing if you don't place it inside the context of trend, flow, and probability. High does not mean expensive, and low does not mean cheap. An asset can be higher than yesterday and still be very cheap compared to where it is about to go. A market can be lower than last month and still be very expensive if the downtrend hasn't finished. Bottom pickers often don't buy because they have an edge. They buy because price is lower than their memory. It was higher before. Seeing it at this price is unbelievable. Can it really drop more? Those questions have nothing to do with probability. They have to do with emotional comparison. The human brain is terrible at evaluating absolute value. It is only good at comparing, compared to the old high, compared to yesterday's price, compared to the level you missed. And with that kind of comparison, low prices create a fake sense of safety. The trader feels like they're buying cheap, but in reality, they're buying a falling knife. Similarly, top pickers often don't short because there's a clear distribution signal. They short because price is above the zone they are familiar with. It can't go up forever. This zone is definitely too high. But too high for whom? For you, not for the market. The market has no concept of expensive or cheap based on emotion. It only has supply and demand at that moment. If buying pressure is still strong, high can go even higher. If selling pressure hasn't dried up, low can go even lower. Top-bottom pickers often get trapped in a very dangerous belief. I'm buying low, selling high. But that's a textbook sentence, not a survivor's sentence. Survivors don't care whether they buy low or high. They care whether they buy where probability leans in their favor. One very noticeable thing is, top-bottom pickers talk a lot about value. This price is irrational. The market is mispriced. It can't be like this. But they are not long-term investors. They don't have an information edge. They don't have the right to wait for the market to return to value. They have one small margin account and one fragile stop loss. Value does not keep you alive in the short term. Only risk management does. When you bottom pick because you believe price is too cheap, you are trading with emotional sympathy for price. You see it hurting, you see it being dumped, and you want to be the one who saves it. But the market doesn't need saving, and it doesn't pay you for compassion. If there is one clear line you must draw in your head, it is this. High-low is a number. Expensive-cheap is a story in your head. When you enter the market with a story instead of probability, top picking and bottom picking becomes almost inevitable. Part 6. Contrarian bias. There is a very seductive belief in the trading community. A belief that sounds wise and very easy to feed the ego. It is the belief that if everyone is long, I must short. If everyone is bearish, I must buy. Traders tell themselves the crowd is always wrong. To win, you must go against it. It sounds sharp. It sounds like the thinking of someone who understands the market. But in reality, the market does not operate like the crowd always loses. The market doesn't pay for being contrarian. The market pays for timing. Contrarian bias. The psychology of going against the crowd is easily mistaken for independent thinking. But those are not the same. Independent thinking is evaluating probability based on data and market structure. Contrarian bias is reacting in the opposite direction just because too many people are on one side. Many traders don't actually analyze the market. They analyze the crowd's emotion. They scroll social media. They read comments. They watch who is long, who is short. And when they see everyone thinking the same, they feel discomfort. Discomfort because they fear becoming ordinary. Discomfort because they fear following. Discomfort because they fear not being smart enough. So, they take the opposite trade, not because the market has shown a reversal signal, but because the ego refuses to stand with the crowd. There is a very dangerous sentence traders say to each other. Smart money eats dumb money. The crowd is dumb money. It sounds cool, but it's an oversimplification. The crowd is not always wrong. Most of the time, the crowd is the trend, and trends exist because big money is flowing in a certain direction. Going against big money doesn't make you smarter. It just makes you fight something much stronger than you. Traders with contrarian bias usually enter very early. They don't wait for structure to break. They don't wait for clear signs of weakness. They enter because they believe, if I wait for confirmation, it will be too late. But the truth is, most real reversals give many signals before they happen. Traders just don't wait, because waiting means accepting that the crowd might be right for a little longer. Contrarian bias makes traders confuse two roles. going against a trend when conditions are there, and going against a trend just to prove yourself. One is strategy, one is ego. And the market doesn't care which one you are. It only responds to your position. One noticeable thing is, contrarian traders are often very proud of it. They treat always going against as proof of intelligence. They feel different. They feel not led by the nose. But different does not mean correct. And independent does not mean profitable. There is one sentence you must remember clearly. The market doesn't care who you stand with. It only cares whether you stand at the right time. If you short just because everyone is long, you are not a disciplined trader. You are someone emotionally reacting to the crowd. Part 7. Addicted to the thrill. There is a truth very few traders dare to admit, even to themselves. It is this: many people are not addicted to profits. They are addicted to feelings. And in trading, no feeling is stronger than catching the exact top or the exact bottom. The moment you enter in the most dangerous zone of the market, your heart beats faster. Your eyes glue to every candle. Your brain tightens with every tick. That feeling is very similar to gambling, very similar to standing on the edge of a cliff and looking down. And the human brain likes that. Top picking and bottom picking triggers dopamine harder than any other style of trading, because risk is high, because outcomes arrive fast, because if you are right, the victory feels intense. Meanwhile, trend following is boring. Entry on a pullback, clear stop loss, scaling out, no drama, no climax. And for a brain trained on stimulation, it feels like watching a movie with no climax. Traders don't say this out loud, but subconsciously they think, this kind of entry profits too slowly. There's no feeling. I don't feel alive. So they start creating feelings. They look for more dangerous entries. They tighten stops even more. They enter earlier than the signal, not because of strategy, but because they need the feeling. One very clear sign of thrill addiction is when a trader can't tolerate silence, when the market moves smoothly, when there is no clear setup, when there's no legitimate reason to enter. They feel restless. They feel itchy. They feel like they're missing something. So they enter a trade just to soothe that emptiness. Top picking and bottom picking is the perfect drug, because it always delivers drama. Either you win fast, or you lose painfully. Both are stimulation. But the problem with dopamine is, it needs higher doses over time. One correct bottom catch is not enough anymore. You need to catch earlier, more dangerous, bigger size. And then trading is no longer a probability game. It becomes an addictive loop. Traders say they want freedom, but in reality, they are chained by feeling. The irony is, the traders who survive the longest usually feel very little emotion when they enter. No thrill, no extreme excitement, no excessive anxiety. They don't need feelings. They need consistency. If you notice you keep searching for dangerous but attractive trades, stop and ask one straight question. Am I trading to make money or to feel like I'm alive? The market doesn't pay for strong emotions. It pays the people who can endure boredom. Part 8. Why top picking and bottom picking destroys accounts faster than you think. If you ignore all theory, ignore all psychological analysis, and only look at the final results, then the truth is very simple. Top picking and bottom picking is one of the fastest ways to make an account bleed steadily. Not because it is never right, but because the way it is wrong is extremely dangerous. Wrong in a way that makes you lose control. The first feature of top-bottom picking trades is very tight stop loss. Traders tell themselves, if I enter at the top, the stop must be tight. If the top is broken, I'm wrong. It sounds reasonable. But in reality, the market rarely reverses cleanly. It spikes. It sweeps. It pierces zones traders believe are impossible to break. So what happens? Stops get swept again and again. One trade after another. Each one loses a little, not too painful, but exhausting. And that exhaustion makes traders impatient. They increase size. They enter earlier. They try to catch it no matter what. And then the second mistake appears, averaging down. Traders tell themselves, price is only going a little against me. I'll add more to get a better average. It just needs a small bounce and I can get out. But the market doesn't care about your average price. It doesn't know how much you're down. It keeps moving with the flow. A first idea that was only a little wrong turns into a position that is too large. Risk explodes. Stop loss gets pushed farther. Discipline disappears completely. And then the trader is no longer trading. they are praying. One very dangerous aspect of top-bottom picking is that the win rate is often quite low, but when it's right, it wins big. This creates a very toxic illusion. Traders remember the big hits vividly, but they don't add up the total damage of the 10-15 wrong trades before that. One right trade cannot cover 10 wrong trades, but the brain thinks the opposite. It remembers the winning moment. It forgets the losing streak. So, the trader continues. Another problem is psychological pressure. When you pick tops and bottoms, you are always positioned against the current movement of the market. That means, right after entry, you are often negative. Negative very fast. Negative very deep. This erodes your mind aggressively. It makes you unable to stay calm enough to make correct decisions. You cut the right trades too early. You hold the wrong trades too long. Both kill the account. Even worse, top-bottom picking makes traders lose market rhythm. They get addicted to hunting reversals, so they miss the clearest trends. While others make steady money with the trend, they keep fighting the market, and the market always wins those fights. If you look back at your account honestly, you will likely see a familiar pattern: many small losing trades, a few big winning trades, but overall flat or negative. Not because you're not smart, but because the risk structure of top-bottom picking is already working against you. Part 9. Top-bottom picking. For sixth trend. Following. The real difference is identity. If you only look at the surface, top-bottom picking and trend following look like two different technical styles. One goes against, one goes with. But the real difference is not on the chart. It is in identity, how a trader sees themselves. Top-bottom pickers often carry a very clear identity. They don't want to be ordinary. They don't want to be a follower. Deep down, they want to be the one ahead, the one who sees what others don't, the one who proves they have skill. Trading becomes a way to validate the self. Each trade is a test of ego. If right, they don't just win money, they win an imagined version of themselves. If wrong, they don't just lose money, they get identity pain. That's why they cannot accept normal losses. They need the loss to be for a reason, to be swept, to be the market cheating. Trend followers are different. They don't try to prove they're smarter than the market. They accept the market is much bigger than them. They don't try to guess. They wait for the market to speak its intention, and this requires real humility. Trend followers are not ashamed of entering late. They don't feel inferior because they didn't catch the bottom. They understand something simple. They don't need the first part. They only need the high probability part. Their identity is not tied to a single trade. It is tied to the process. They can lose 5 trades in a row without shaking their sense of self, because they don't treat losses as a reflection of intelligence. Top-bottom pickers are the opposite. Every wrong trade is a hit to the ego. And to protect that ego, they start justifying, changing rules, loosening discipline, not because they want to cheat, but because their identity cannot tolerate being wrong. One very important point: trend followers don't need to feel special. They don't need recognition. They don't need anyone to know where they entered. They only need the account to stay alive. Top-bottom pickers often unconsciously seek recognition from the community, from friends, from themselves. They want to be seen. They want to be acknowledged as good, but the market doesn't reward the need for recognition. It rewards the people who can put the ego low enough to survive. If there is one sentence you must carve into your head from this part, it is: the difference between the two types of traders is not strategy. It is what you are trading to prove you're good, or to build a survival system. Part 10. When is top picking and bottom picking reasonable? Very rare. After everything that has been said, there is a question you cannot avoid. So can top picking and bottom picking ever be right? The answer is yes, but very rarely. And what matters more is, it is not for most traders. Top picking and bottom picking is not an advanced skill that beginners should aim for. It is something that only appears after a trader has passed through many layers of discipline, experience, and self-understanding. The cases where top-bottom picking is reasonable often share a few clear features: not flashy, not impulsive, and completely unrelated to proving yourself. First, very long-term experience, not just a few years of looking at charts, but multiple different market cycles, bull-bear, sideways, crisis, recovery. This kind of trader is no longer excited. They have seen enough. They know the market can go farther than imagination. So, they do not rush. Second, steal discipline. A true top-bottom picker does not break rules. They don't average down recklessly. They don't widen stops out of hope. If wrong, they cut. No hesitation, no excuses. They understand top-bottom picking is a very low probability game. So, every trade must be controlled at a very small risk level. Third, extremely tight risk management, small size, very low risk per trade, and the willingness to accept many losses in a row. This kind of trader doesn't need one big hit to survive. They already survive. One very important point. These traders don't need to prove anything to the market. They don't show off. They don't tell stories. They don't chase recognition. If they catch it right, it's just one result among thousands. If they catch it wrong, they cut and move on. No story, no legend. No, I saw it first. And here is the most important thing that very few people understand. The traders who can catch tops and bottoms correctly don't like doing it. They only do it when conditions are painfully clear, when structure is complete, when risk is compressed so small it becomes insignificant. If you notice you really love top picking and bottom picking, there's a high chance you're not at that stage yet. Not because you're weak, but because you still need to prove something. If there is one message you should carry from this part, it is: top picking and bottom picking is not a destination. It is the consequence of an identity that has matured enough. Part 11. Psychological exercises to drop the top picking, bottom picking habit. If you've reached this part, there is one important thing that must be said clearly from the start. The habit of top picking and bottom picking does not disappear just because you understand it. Understanding is only the first step. Change happens when you create a new experience for the brain, and that requires exercises, not technical exercises. Psychological exercises. The first exercise is simple, but extremely hard to do honestly. Journal the reason you entered, not analysis, not indicators. Just answer one single question after each trade. Did I enter this trade because of a signal or because of a feeling? At first, you will label many trades as signal, but if you're a bit more honest, you will start seeing familiar sentences. Price is too high already. It feels like it's about to turn. If I don't enter now, it'll be too late. The moment you can identify that, you have already done what most traders never do. Look straight at the real motive. The second exercise is to mark trades where you entered earlier than the plan. No judgment, no immediate fixing. Just mark it. Every time you enter before the point your plan requires, write a note. After a few weeks, you will see a very clear picture. Most of the heaviest losses come from the moments you couldn't wait. This exercise teaches the brain to link early entry, Sask's pain. And that is the only way to break the old loop. The third exercise is the hardest one. Practice staying out when you really want to enter. It sounds simple, but this is where the ego resists the hardest. When you see price go very high or drop very deep, when everything inside you screams, enter, do one single thing, stay out. Not for the market, for yourself. Observe the feeling, the restlessness, the discomfort, the tension, and do nothing. You will realize something very important. The urge to enter always dissolves on its own if you don't act on it. This is the moment a trader moves from reflex to choice. The fourth exercise is to separate identity from each trade. After each losing trade, say out loud or write, "This trade lost. But I am not wrong." It sounds strange, but this is how you reteach the brain. Your value is not in short-term outcomes. When identity is no longer tied to each trade, you no longer need to catch tops and bottoms to prove anything. The final exercise is to set staying out rules as part of a strategy. For example, if price moves too far away from the standard entry zone, don't enter. If there is no confirmation signal, don't enter. If emotion is too strong, don't enter. Staying out is not failure, it is a deliberate act. And when you treat staying out as part of the system, top picking and bottom picking will gradually lose territory. If you've listened this far, you've probably realized something important. Top picking and bottom picking was never a technical problem. It is the problem of the human standing in front of the chart, not because you lack knowledge, not because you don't have enough indicators, but because deep inside, you once wanted to be the most right, the earliest, the one who saw it before everyone. And that is very human, very normal. But the market is not designed to feed the ego. It is designed to expose the ego. Every time you try to pick the top or pick the bottom, The market doesn't ask if you're smart. It asks one cold question: how long can you withstand this risk? And most traders cannot. Maturity in trading doesn't come from how many reversals you catch. It comes from the moment you no longer need to catch them, when you no longer need to prove anything to the market. No need to prove you're good. No need to prove you're different from the crowd. You only need one thing: stay long enough. Remember this sentence, not to memorize it, to live with it every day in front of the chart. The market doesn't reward the person who enters the earliest. The market rewards the person who stays the longest. If today you were able to stay out of one trade that in the past you would have jumped into to catch a top or catch a bottom, that is not a missed opportunity. That is progress, quiet progress. No one claps, no one knows, but your account will know. And your future trader self will thank that decision. Trading is not a contest to see who is smarter. It is a journey of learning how not to destroy yourself. And when you can do that, profit is only a consequence.